It is 11:07 a.m. Pacific Standard Time. It's the 9th day of December 2025, and this is episode 1226 of Bitcoin. And the CFTC has launched a pilot program allowing Bitcoin to be used as collateral in derivatives markets. Oh joy! What could possibly go wrong? You're here at the Bitcoin and podcast with your host, me, David Bennett, bringing you all the news that you can use and more about Bitcoin and the rest of the macro stuff around the world, especially where it collides, like using Bitcoin as collateral in derivatives markets. I'm just... The gambling needs to stop, people. It just needs to stop. But we're also going to talk a little bit about Malaysia's crown prince and stablecoins, and then we're going to talk about PNC Bank. They're getting into the Bitcoin game as well. The OCC, the Office of the Comptroller of the Currency Chief, is not happy about banks possibly blocking crypto custody. We'll get into why he thinks that. And 17-year resilience has ended the tulips narrative, according to Eric Balchunas. We'll get into what he's got to say about all that. And then we've got a Bitcoin coalition pushing back against the whole MSCI proposal. Honestly, I kind of think we should just let MSCI die into, not die. It's not going to die. It's been here for years. But we gave it life. We gave it a name. Now we know what MSCI is because everybody's freaking out about it. Maybe we should just stop talking about it. We didn't know about it before and it didn't hurt us. But now that we know that it exists, the pain. The humanity. Oh my God. So maybe we should just let that one die. But we should, but I am going to be talking about it. And of course, Saylor is out there at the Abu Dhabi MENA conference and he's saying other stuff to other people. We'll end the day with that one. But first, the CFTC and Bitcoin as collateral in derivatives markets. Oh, joy. Micah Zimmerman, please tell us what this is all about from Bitcoin Magazine. The Commodity Futures Trading Commission announced the launch of a United States digital assets pilot program that will allow Bitcoin and shitcoin number one, as well as the stablecoin USDC, to be used as collateral in regulated derivatives markets, marking yet another major policy shift in how U.S. regulators approach tokenized assets. The move includes guidance for tokenized collateral, a limited, no-action framework for futures commission merchants, and the withdrawal of legacy restrictions that the agency said are no longer relevant following passage of the Genius Act. Acting CFTC Chair Carolyn Pham said the program is designed to expand the use of digital assets in regulated markets while maintaining oversight and customer protections. Quote, Americans deserve safe U.S. markets as an alternative to offshore platforms, Pham said in a statement. Today, I am launching a United States digital assets pilot program for tokenized collateral that establishes clear guidelines to protect customer assets and provide enhanced CFTC monitoring and reporting. Under the pilot, FCMs, which is that Futures Commission Merchant moniker, will be temporarily allowed to accept a narrow set of digital assets like Bitcoin as customer margin, according to a CFTC announcement. The minute they said margin, all I can think of, every time somebody says margin, all I can think of is this. The movie Trading Places with Dan Aykroyd and Eddie Murphy. When the Duke brothers of Duke and Duke lose their chairs on the stock exchange, on the Chicago, I think it was the Chicago Stock Exchange, I can't remember what it was, because their margins had been called and they didn't have enough collateral or cash to cover it. So they put their seats on the exchange up for sale. It's a great movie. If you haven't seen Trading Places, it's actually a long lost Christmas movie. Right, so you might want to watch Trading Places. Dan Aykroyd, Eddie Murphy. It's a great flick. Anyway, let's get back to this. During the first 3 months of participation, firms will be required to submit weekly reports to the CFTC detailing the total amount of digital assets held in customer accounts, broken out by assets and account class. Companies must also notify regulators of any material incident involving the use of digital collateral. The agency said the reporting requirement is intended to give staff real-time insight into operational risks while allowing firms controlled access to tokenized collateral. Last week, the CFTC allowed federally regulated spot crypto trading in the United States for the first time, with Bitnomial set to launch its exchange next week under CFTC oversight. FAM said CFTC registered venues will list spot crypto products, enabling retail and institutional traders to access spot, futures, options, and perpetuals on a single regulated platform. Alongside the pilot program, the CFTC's Market Participants Division, Division of Market Oversight, and the Division of Clearing and Risk issued formal guidance on how tokenized assets should be evaluated within existing regulatory frameworks. The guidance emphasized that CFTC rules are, quote, technology neutral, and that tokenized assets should be assessed individually under existing policies rather than treated as a separate asset class. Well, the framework applies to tokenized real-world assets such as U.S. Treasuries and money market funds. It also outlines standards for legal enforceability in things like custody and control. The agency also issued a no-action position for FCMs that accept non-securities digital assets as margin, including payment stablecoins. The relief allows firms to incorporate qualifying digital assets into customer accounts while clarifying how capital and segregation rules apply under the new regime. The CFTC formally withdrew staff advisory number 20-34, which previously restricted how virtual currencies could be held in customer accounts. The advisory had been in place since 2020. The agency said developments in digital markets and the enactment of the Genius Act made the advisory obsolete. Yeah, we've kind of talked about this a little bit before. I think I brought it to you last week, this part of that. But allowing Bitcoin to be used as margin collateral for derivatives market, I think is just testament to a couple things. One, degenerate gambling. Two, the fact that degenerate gambling has just it's bolted itself so firmly into what we think of as traditional financial markets that we can no longer separate the two. There is a place for traditional markets. Price discovery. How much it's like prediction markets. How much is something worth as it pertains to what a whole bunch of people think it's worth? Okay, that's sort of like a nutshell of price discovery. A little bit. I mean, there's more to it than that, but derivatives don't do that. People will tell me that I'm wrong, and I'm just going to not listen to them because I'm not wrong. Derivatives is a bolt-on to traditional markets, and they do nothing but allow people to gamble on what they think the price is going to be given what a lot of other people think it is. They're basically betting at one point or another on some delivery date what price discovery will be in the traditional markets on some commodity or equity or something else. Allowing people to stack their Bitcoin as a margin against making those bets isn't any different than just using cash or some other marketable security or collateralizable security. It's just that they're going, well, shit, people's got a lot of Bitcoin and we're seeing it as valuable, so now we're going to take it as collateral. Well, that puts us right back into, like, what was it, BlockFi? The people that were allowing massive loans to be taken against Bitcoin, and you could get like, I don't know, I think they got up to the point where they would loan you 80%, I think is what the top number was. 80% of what your Bitcoin was valued. So if you experienced a 21% drop, you'd get liquidated and you'd have to come up with even more money, right? So it's going to be the same here. It's just probably going to be on a much larger scale depending on how many people actually take part of it, but it's just gambling. And it's just allowing Bitcoin to be used in the gambling part of traditional financial markets. Let's go into the South Pacific, Malaysia. Malaysia's Crown Prince targets ringgit stablecoin, Zetrix Treasury, Helen Parts Coin Telegraph. The eldest son of Malaysia's billionaire king, so he's not the ruling guy, he's just the prince, right? Malaysia's billionaire king is launching a stablecoin pegged to the national currency, targeting payments across the Asia-Pacific region. Bullish AIM, a telecom company owned by Ismail Ibrahim, the son of Sultan Ibrahim Iskandar of the Johor royal family, on Tuesday announced the launch of RMJDT, a brand spanking new stablecoin backed by the Malaysian ringgit, the country's fiat currency. The stablecoin is set to be issued on Zetrix, a layer 1 blockchain designed to connect governments, businesses, and individuals to the Web3 economy with a focus on cross-border integration, particularly in China. In addition to launching the stablecoin, Bullish AIM will also establish a digital asset treasury company with the initial treasury allocation of 500 million ringgit, or $121.5 million US, in Zetrix tokens, the announcement said. According to the announcement, RMJDT is launched under Malaysia's regulated sandbox framework by the Securities Commission and Bank Negara Malaysia, aiming to test financial innovations, including stablecoins. Launched in June, the sandbox aims to explore digital asset use cases such as programmable payments, ringgit-backed stablecoins, and supply chain financing. RMJDT is designed to strengthen the international use of the Malaysian ringgit in cross-border trade settlements and to act as a catalyst for attracting increased foreign direct investment into Malaysia, the announcement read. Addressing its 121 million Zetrix DAT, a digital asset treasury, Bullish AIM said it plans to increase the treasury to $243 million. Bullish said the DAT is modeled after global precedent centers like Michael Saylor's strategy. Yay, you're a little late to the game there, pal. Quote, as the issuer of RMJDT, we view the establishment of a Zetrix token treasury as a strategic necessity, both to support operational stability and to deepen alignment with the national blockchain. Oh, wow. National blockchain. The national blockchain. That's, yeah, we'll probably need to be looking out for that phrase here in the future. Bullish AIM is entering the DAT sector as many companies with digital asset treasuries face struggles. Ismail's reported 2.7 billion Singapore land sale bid in August shows how cash-rich players continue to bet big, despite growing concerns over strategy copycats. According to CoinShares head of research, James Butterfield, the DAT bubble may have already burst following a rally in the summer of 2025. Quote, as the bubble deflates, the market is reevaluating which companies genuinely fit the DAT model and which were simply riding momentum, Butterfield said in a DAT update last week. He also suggested that the future of DATs will be linked to fundamentals such as disciplined treasury management, credible business models, and realistic expectations about the role of digital assets on a corporate balance sheet. Cointelegraph approached Bullish AIM for comment and not received any response at time of publication. So the Prince of Malaysia, not the king, but the prince, the eldest son of the billionaire king of Malaysia, is launching a stablecoin. And they're putting together this digital asset treasury that is using a token on a platform that I've never heard of before. And this is Malaysia. This isn't like some podunk country. This isn't a third world shithole. I'm sure there are places in Malaysia that are shitholes. There are in the United States too. Have you seen Detroit? Just saying. But in either event, I don't think this is really going to go where the son of the billionaire king of Malaysia thinks it's going to go. I think we're going to forget about this in time, and I'm pretty sure that they might actually lose their ass, but That's for Malaysians to worry about, not me, because I don't live in Malaysia. I just don't. So let's talk about PNC Bank. And they are rolling out spot Bitcoin access for private clients after a 2025 reveal. Helen Braun is writing this one for CoinDesk. PNC Bank is now offering direct Bitcoin trading to its private banking clients, becoming the first major U.S. bank to embed spot Bitcoin access inside its digital banking platform. The new feature, which went live on Monday, caps off a partnership with Coinbase that's been in development since 2021 and was formally announced in July of this year. The feature is available to eligible clients of PNC Private Bank and is powered by Coinbase's crypto as a service platform. The integration, which is limited to Bitcoin trading for now, allows clients to access Bitcoin directly within PNC's digital banking platform, removing the need to open or manage separate crypto exchange accounts. Quote, this collaboration demonstrates how traditional financial institutions and on-chain native companies can work together to expand access to digital assets in a safe and compliant way, said Brett Taj-Paul, co-CEO of Coinbase Institutional. Quote, PNC has taken a thoughtful, disciplined approach, and we're pleased to support their efforts with our secure and institutional-grade infrastructure trusted by institutions around the world, end quote. Coinbase handles custody, trade execution, and compliance behind the scenes, giving PNC a way to offer crypto exposure without holding the asset themselves, nor registering as a crypto broker. Coinbase CEO Brian Armstrong said on X, quote, exciting to see more banks embrace crypto like this. PNC private bank clients can now buy, sell, and hold Bitcoin in their existing accounts. PNC is the first major U.S. bank to support this type of offering. PNC and Coinbase formally announced their partnership in July of 2025 though development reportedly began years earlier. Yeah, well, there's no way to tell. At the time, PNC CEO William Demchak said the partnership would help meet growing demand for secure and streamlined access to digital assets on PNC's trusted platform. The move gives high net worth clients an easier path into Bitcoin while letting PNC test the waters without overcommitting. For Coinbase, it extends the company's reach into traditional finance and expands its footprint with one of the top 10 U.S. banks. So yet another bank falling in the line of dominoes that we see just crashing all around us. So yeah, there you go. Makes me hungry, which is why I go to satsforsnacks.com. That's sats, the number 4, snacks.com. Satsforsnacks.com has got the bit chunks that you crave. It's freeze-dried pineapple, yo. Freeze-dried. It's not dehydrated. There's a difference. Have you ever chewed on a dehydrated fruit? Yeah, we were told it was good. Not really. Banana chips, dehydrated, those are okay. That's fine. But something like pineapple and all manner of other fruits, it's like leather. It's like you might as well be chewing on a fruity shoe or something like that. Go to satsforsnacks.com, satsforsnacks.com. Get yourself some Bit Chunks freeze-dried pineapple. Have you ever had freeze-dried stuff? Did you ever get that astronaut ice cream when you were a kid? That's freeze-dried. So if you haven't tried any of this freeze-dried stuff that has come on the market now that everybody and their dog seems to have their own freeze dryer, it's different. It's definitely different than dehydrating something. It is a completely different style of getting the water out of something. And the way that freeze drying works is that what it leaves behind is a really puffy consistency of things. It's not leathery. It's basically, it's sort of like, I don't know, you have to try some. You can also try freeze-dried peaches because he's got just peachy. He's got freeze-dried mango. He has also, freeze-dried banana. That stuff, all of this stuff is really good, but if you've only ever dealt with freeze-dried banana chips, try the peer-to-peel organic freeze-dried bananas from satsforsnacks.com. Make damn sure that you tell them that you heard about it here on the Bitcoin and podcast by using the code Bitcoin, and you will get 2.1% off with that code Bitcoin, and that's 2.1% off of your entire purchase. And it lets Permanerd, which is the owner of this whole thing, know that I made a sale for him here in the Circle P. It's where I bring plebs with goods and services just like you to plebs just like you who want to buy said goods and services with Bitcoin. Because if you're not selling it in Bitcoin, you're not in the Circle P. Go to sats4snacks.com. The OCC chief says banks blocking crypto custody is a recipe for irrelevance. This one I actually agree with, because the train has left the station, people. You're either on it or you're not. Vismaya V from decrypt.co says that banks trying to block crypto custody from the federal system are pushing a recipe for irrelevance. The nation's top banking regulator warned on Monday. He defended over $2 trillion in existing digital custodial activity that industry opponents claim violates federal law. Wow, $2 trillion is that's a lot of money to be violating a federal law with. Jonathan Gould, comptroller of the currency, told the Blockchain Association's Policy Summit in Washington that efforts to prevent national trust banks from engaging in crypto custody ignore decades of precedent and risk stagnating the entire banking system. Well, quote, it's important that we do not confine banks, including current national trust banks, to the technologies or businesses of the past. That's a recipe for irrelevance, Gould remarked. The pushback comes as the Independent Community Bankers of America and Bank Policy Institute have urged the OCC to deny crypto charter applications, claiming they exploit regulatory loopholes. Now, I'm going to pause here just to remind you. Remember, I brought this to you before. The Independent Community Bankers of America and Bank Policy Institute, both of them are lobby institutions for the banks. And they were bitching about this stuff 2 weeks ago, and I brought it to you here on the Bitcoin and podcast, and now they're getting some pushback here by the Office of the Comptroller of the Currency, not by a lobby group, not by some kind of crypto lobby group. No, this is the actual guy at the Office of the Comptroller of the Currency, a federal position, that's actually pushing back against the lobby groups. I don't hear about this kind of thing happening too terribly often, so it's really interesting. But the ICBA filed opposition letters against both Coinbase's application and Sony Bank's Connectia Trust bid last month, warning the applications represent an impermissible reinterpretation of federal law. Gould refuted claims that approving crypto custody services would break with OCC precedent, noting that national trust banks have engaged in non-fiduciary custody activities since the 1970s. Damn, that's 50 years, man. In the third quarter of this year alone, national trust banks reported nearly $2 trillion in non-fiduciary custodial assets under administration, representing a full 25% of their total assets. Quote, prohibiting national trust banks from engaging in non-fiduciary activities would not only threaten to undermine the dynamic and evolving nature of the federal banking system, but would also disrupt well over $1 trillion in traditional activities of existing national trust banks, Gould said. State trust companies in New York and South Dakota already provide digital asset custody services to customers, Gould added, saying that banks have held electronic rights to company shares in custody for decades. Quote, there is simply no justification for considering digital assets differently. End quote. The OCC received 14 de novo charter applications this year, nearly matching the total from the previous 4 years combined. That's how fast this is going, y'all. That's how fast this is moving. Several applications involve digital asset activities or national trust bank conversions, reversing a 15-year slump in which applications average fewer than 4 annually. down from more than 100 a year in the late 1990s. He called the regulatory blockade myopic and said it was, quote, not legally justifiable and contributed to a less dynamic and competitive banking industry, end quote. At the ABA convention in October, the OCC chief countered the banking group's concerns, saying that any stablecoin-driven deposit flight, quote, would not happen in unnoticed fashion, and that stablecoins could help community banks compete with larger institutions. Yeah, well, it's the larger institutions that these lobby groups are seeking to protect, so that is falling on deaf ears, I can guarantee it. But Gould said that the OCC has supervised trust banks for decades, including a crypto-native national trust bank, which is a reference to Anchorage Digital, whose consent order over AML deficiencies was lifted in August after the OCC concluded continued supervision was not needed for its, quote, safety and soundness. Crypto.com, Circle, Ripple, Bridge, which is Stripe's stablecoin arm, and Paxos are the other crypto firms that have filed for national trust charters. Erebor Bank received conditional OCC approval last month. Quote, the federal banking system's capacity to evolve from the telegraph to the blockchain is one of its greatest strengths, Gould said, pledging that the OCC would, quote, resist any efforts to erode its utility and diversity. Dominoes are falling everywhere. And this time, the bull in the china shop that starts the crash of all the dominoes is the actual chief of the office of the comptroller of the currency himself, Mr. Gould. I cannot stress enough how important that it is that a federal official has stepped in and is directly, verbally pushing back against lobby groups for large banks. This is going to be real interesting to see where it goes. Let's run the numbers. CNBC futures and commodities, and whoo boy, energy took a shellacking this morning. Brent North Sea is down a point to 61.92. West Texas Intermediate down over a point to 58.22. But natural gas, coming off of its steep decline yesterday, is down another 6.68% today, and it's back to $4.58 per thousand cubic feet. And that is expressly due to the fact that the weather outlook for the United States shifted again. They were wrong. I guess that means there's not a polar vortex that's going to descend into the Midwest like was thought early, or rather late last week, which caused natural gas to hit like $5.50. That was like half of its all-time high price, which was what, like, I don't know, 2 or 3 years ago. Or actually maybe even 4 years ago, come to think of it. It's all crashing back down, including gasoline, which is down a half point to $1.78 a gallon, and Merbon crude, everybody's favorite light sweet crude, is down over a point to 63.56. Gold and its brethren are having a good day today. Palladium is up 2 full points. Gold is up a half to 42.37 and 9 dimes. Platinum is up 2.95%. Silver is up, whoa, holy shit, 4.8%. 61.22 an ounce. Copper is down 2.25%. Ag looks to be fairly mixed this morning. The biggest winner is chocolate, 3% to the upside. The biggest loser today is sugar, 1% to the downside. Meanwhile, live cattle up 0.13%. Lean hogs down almost a half, and feeder cattle down 0.07. So essentially moving sideways, as is the S&P, which is in the green by 0.01%. NASDAQ is up 0.18%. Dow is down a quarter, and the S&P Mini is up a quarter. And that's because why? Because tomorrow we get the Fed minutes. And we saw after a JOLTS labor report was a job, or sorry, well, it's a labor report, but it's the JOLTS job opening report. The numbers came in higher than expected. There's already been an 83% chance that we are going to get a 25 basis point cut tomorrow by the Fed because of the JOLTS job opening reports. That percentage probably is way higher that we're going to get a cut because, hey, we got job openings are opening up. We need to, yay. So people are looking at this as a signal that it's going to be even easier for the Fed to actually, give us another rate cut. And of course, Bitcoin responded profoundly to the jobs report because we rocketed past $89,000 to hit 94,112. We're settling back into 93,950. That's a $1.88 trillion market cap. We can get 22.3 ounces of shiny metal rocks with our one Bitcoin, of which there are 19,959,651.16 of, but average fees remain low at 0.02 BTC taken in fees on a per block basis. It's about 32 blocks carrying 59,000 unconfirmed transactions waiting to clear at high priority rates of 4 sats per VByte. Low is 2 sats per VByte. And we are still in zettahash territory for network security. We have 1.05 zettahashes per second as the hash rate on the Bitcoin network, and that's more than you will ever need. From Beals, Banks, and Bells, yesterday's episode of Bitcoin, and I got pushback by TK Suitcoin, and I just did it again. I accidentally clicked on something, and now I got to reset my page. There we go. TKSuitcoin.exe says, yeah, remember, we're talking about intellectual property. If you heard me talking about this last night or yesterday, he says, referring to the idea of you wanting someone to convince you that nobody would steal your book ideas. It's an impossible task to ensure nobody could do so 100% in today's digital age. We have ways to gatekeep digital information, but that doesn't stop it from spreading. Good information /news/books wants to be free always. You can only defend the physical copies of the book. He's not lying. That's a true statement. You could never stop someone from hacking your PC and getting your ideas if they really wanted. Now, with the ability to digitally distribute such ideas quickly, someone trying to copy your ideas and calling it their own would be called out quickly. I believe this is lacking in today's society, but I believe in a world of honest money, those wishing to steal ideas like you suppose would be called out fast. In a hard money economy, I believe this could be settled in civil courts very easily. But this ability to sue anyone who takes your characters or worlds that you create and add to or iterate upon would go to the wayside. Also, when I said things, I didn't mean just random things in general. I meant obviously market-tested ideas that survive to be profitable endeavors. Nobody's making random shit for the sake... I love how he puts it. Nobody's making random shit for the sake of shit in a Bitcoin world. Again, there's several things that I don't disagree with. And he's right. If somebody wants to hack my computer, grab an idea for a book, great. I can't do shit about that. And he's 100% right. I can't do anything about that. Let me put it to you this way. And again, it's going to sound like pushback, but I want to state clearly. I was not talking about somebody stealing my book ideas. I was talking about somebody stealing a book. And I'm just using a book as a placeholder for anything else. I don't have a book. I have not written a book. Maybe one of these days I will. It depends. Think about it this way. Saifedean Amis's book, Bitcoin Standard. That is a published book. I'm absolutely certain that I would be able to get a hold of a digital copy of every word that's written in that book. And I was probably in a position, or I could have found myself in a position to be able to get that before that book was actually published. Right? So now let's look at it this way. Let's say Safe's about to publish the book. I've got a digital copy of the proofed manuscript. That's going to be what actually gets printed in the book. It's been proofread. It's been vetted. Yeah, we're going to spend the money actually putting this on pages, and we're going to shove them into a book and a hardcover and a softcover, and we're going to sell that shit. But I just beat them all to the punch. And I start selling Saifedean Amis's book under the author name David Bennett. If there's no intellectual property rights, then there's absolutely no way there's going to be a court case. Because I'm not stealing property. There is no property. If there's no intellectual property, then there's just no property here. I can do whatever I want with it because it's mine. Because there's nothing guarding the intellectual prowess, the work that went into actually drafting the words on the page that Saifedean Amis took. He spent a long part of I think it was over a year to write that book. And all of that got seeded with his years of teaching economics. And I can't remember where he was. It was Princeton or Harvard or something like that before he stopped being a professor and said, fuck it. He went into Bitcoin full time. So he spent all that time getting to a point where he had a much of a, and then he spent a lot of time in Bitcoin being able to formulate a good, solid, cohesive idea. And then he had to sit down and physically start writing shit out and then doing all that work. Right. But I just take it. I just take it from him. And I just start selling copies of it. I don't even change the name. Bitcoin Standard by David Bennett. And nobody can stop me because there's no such thing as intellectual property rights. There's Saifedean could say, I can prove that I had the manuscript first. Fine, fuck it. Prove it. I don't give a shit. You ain't got no recourse. There's no civil suit. You can't sue me. There's nothing that tells anybody that this is yours and not mine. And there's also nothing that says it's mine and not Saifedean Amis. So he could actually say, well, then fine. I'll just go ahead and print my copy of it as well and compete against you on the open market. But I've beaten him to the punch. Everybody thinks it's David Bennett that did it. And now they start calling Saifedean Amis as a plagiarist because they're not going to look behind the scenes to see how he can prove that he had all that he wrote that first. Yes, what I'm saying a bit hyperbolic? Yes, I will admit that, but I'm doing it to prove a point. Or not even prove a point, just to illustrate where I'm coming from when it comes to intellectual property. Do I believe that intellectual property should cover things like the Happy Birthday song, which is actually a song owned by Disney? Yes, if you did not know that, that's why you've never heard anybody sing Happy Birthday on TV, because they will get sued by the Disney Corporation. Do I think that's right? Fuck no. That's fucking stupid. And I also don't think that they should be able to re-up all of their patents on Mickey Mouse, which has been around since the 1930s, right? And plus their branding at this point, nobody's really going to be able to do it. And that's where me and TK actually agree. It would definitely be called out on the open market. But the Happy Birthday song, that has always gotten to me about, that is where I agree wholeheartedly with TK here. That is a bullshit claim. Happy birthday to you. I could get sued just doing that shit, except that it's under 5 seconds. So I could probably make an argument that I didn't actually violate the terms of the intellectual property owned by the Disney Corporation. But you see what I'm saying? Again, this really, for me, it goes back to this description that I was given about the Supreme Court case and the People versus Larry Flint. I don't know how to define pornography, but I know what it is when I see it. And I think that's a big issue here in intellectual property, patent rights, that kind of stuff. So while me and TK disagree about a couple of things, I think we would be able to have a nice, cordial discussion about this face to face without trying to throw bottles of beer and shit at each other. But I always do appreciate these kinds of pushback. If you think I'm wrong, dude, you have every right to say, I think you're wrong, and here's why. And it makes for good conversation. So TK, thank you for that, and thank you for the 500 sats. Permanerd with 210 says, pies? Bueller? Pies? Code with 500 says, it isn't about being pro or anti-IP. It's simply that you will not be able to enforce IP, intellectual property. Imagine someone in China lists your book as a download and successfully markets it via pseudonymous and then takes payment via Lightning. How do you sue them? Now that person better able to fight off criticisms of stealing, or their reputation will take a permanent hit. Oh, this is interesting. That's how I see it going always. I agree with Sovereign Individual's prediction here. Again, it's not that I wholeheartedly disagree and I think everybody's dumb but me. That's not the point when I give pushback. But it also does become rather problematic if nobody can defend their property rights and somebody is a creative individual and again, go back to a book and wants to write a book, and it just, they write 3 and all 3 of them just get ripped off by somebody with better marketing. Let's say they don't even steal it. They just like, oh, hey, this new book came on the market. We got AI to read it. It came out. It hit the shelves yesterday. We can be on the shelves by this weekend. And they would be able to do that, by the way. That exists. And just steal the book. And then compete on the open market, but with a shit ton better marketing. If nobody can defend how they make money, if they are making money in a creative way, then how does creation itself get affected? I mean, I create this podcast. It does not it makes hardly any money. Let's be honest. But a lot of that has to do with the fact that I haven't really approached any, corporate kind of advertisers. One of these days I might. I don't know. It doesn't matter. But right now, this is a creative endeavor for me. I view it as service. And from that standpoint, since I'd never really entered into it expecting to get oodles of cash, then, and nobody's really, nobody's stolen, anything from me. And I get that. But, what I'm saying is that this particular creative endeavor for me, I've made a judgment call on why I do it. I might try to do something else. And if that gets stolen, because there's no way to guard against it at all, do you think that I would be chomping at the bit to create something more? Let's say it was good. And I get nothing for it. Nothing at all. It was just a waste of my fucking time. Am I more or less likely to create something else? If I'm less likely to create something else because of that situation, what does that say for all of humanity? If everybody's getting ripped off all the time, does the overall creativity of humanity increase, stay the same, or decrease? I'm not going to make a judgment call on that. I want you guys to answer that for me. Nick_Dose. 117 sats says cheers, and Pies is here finally. Thank you, Pies. 121 sats, but he's got a whole bunch of emojis that I can't see, and that is the weather report. Welcome to part 2 of the news that you can use. Bitcoin's 17-year resilience ends Tulip narratives, says Balchunas. This is written by Nima for Bitcoin News. Bitcoin has often been compared to the famous tulips bubble from the 1600s, a time when tulip prices soared and then crashed suddenly. But according to Bloomberg ETF and analyst Eric Balchunas, this comparison no longer makes sense. He says Bitcoin has proven itself by surviving for 17 years and recovering many times, which is something tulips never did. Balchunas explains that tulip mania rose and collapsed in just about 3 years. After the crash, prices never recovered. He believes Bitcoin's long life alone is enough reason to stop comparing it to Tulip, since Bitcoin is still up like 253% for the past 3 years and was up 122% just last year. The Dutch tulip bubble happened between 1634 and 1637. Tulip bulbs became extremely valuable, and rare ones sold for more than houses. But the boom quickly turned into a crash, and prices fell by more than 90%. After that, tulip prices never went back up again. It was a short-lived bubble that disappeared as fast as it came. Bitcoin, on the other hand, has gone through many ups and downs, but continues to return. Over the years, it has survived big crashes, regulatory pressures, exchange failures, and global market fears. And despite all of this, it still reaches new all-time highs. As analyst Gary Krug, head of BTC strategy at Affinitio AG, noted, quote, bubbles don't survive multiple cycles. Regulatory battles, geopolitical stress, halvings, exchange failures, and then still return to new highs. Some critics argue that tulips, or Bitcoin, like tulips, because it doesn't produce anything. But Balchunas responded that many valuable assets are also non-productive. He said, quote, yes, Bitcoin and tulips are both non-productive assets. But so is gold. So is a Picasso. So are rare stamps. Would you consider those to tulips or compare those to tulips? Not all assets have to, quote, be productive to be valuable, end quote. He added that he thinks Bitcoin is a different animal. Many people disagree with the claim that Bitcoin is non-productive. They argue that it introduces something previously unavailable, a trustless, permissionless, and uncensorable way to transfer value globally. And it does so much faster than traditional banking. This debate is not new. Some well-known figures continue to dismiss Bitcoin. Investors like the Big Short's Michael Burry once called it the tulip bulb of our time, and JP Morgan CEO Jamie Dimon said it was worse than tulip bulbs back in 2017, but Bitcoin's growth and long-term survival make that criticism harder to support today. Balchunas also commented on Bitcoin's price movements. He believes that the recent price drops are not a sign of collapse, but simply a normal market correction. Quote, if you think about Bitcoin's year, all that really happened, at least up until this point, is it gave up the extreme excess of last year, he wrote. He then explained that Bitcoin went up 122% last year, so a pullback is natural. In his words, quote, assets are allowed to cool off once in a while, even stocks. People are over-analyzing it, in my opinion. Even with volatility, Bitcoin is still up over 250% in the last 3 years, and in Balchunas' opinion, this kind of performance is unusual for something critics call a bubble. True bubbles burst once. They don't recover repeatedly over nearly 2 decades. Balchunas thinks Bitcoin's history could also change how institutions view it. As more financial companies invest in Bitcoin and Bitcoin ETFs, it is becoming more accepted as a long-term asset, and many experts now see Bitcoin as a growing part of the global financial system rather than just a speculative craze. That's the end of the article. So let's look at it. Let's take devil's advocate position on this, because I agree with Eric, but here's the thing. If you actually go look at the tulip price index from 1633 all the way past 1637, the 3 to 4 years that this stuff, was going on, what you see is 3 peaks. You see a peak in valuation, and then it dips back down. And you see a bigger peak in valuation, and then it dips back down. And then you see a huge, massive freaking spike, like literally 10x from its first all-time high, if you look at it that way. And then a crash to back where it was before all that shit started before. And that was like, 3.5 years? Let's just call it 3.5 years. Balchunas is saying because it's now 17 years for Bitcoin, that doesn't work. So the devil's advocate in me automatically goes, how did we perceive time in the 1630s versus 2025? I posit that we have rapidly increased the passage of time for all manner of things, what our expectations are, how fast it is to build a building, how fast it is to build a car, how fast it is that all that shit I just mentioned, ends up in a junkyard somehow or another. And, I think that I would caution Mr. Balchunas to say, okay, look, 3.5 years in 1630 might actually be more like 17 years in 2025 than we think. We don't really know how people thought about the passage of time back then. They certainly didn't have the internet. They didn't have instant access to God only knows how much information. They had a Bible, and it was probably handwritten by a monk. And they had a few other things that were probably handwritten by monks. They didn't have access to information that we have today. I think that time moves much quicker in today's age than it did back in the tulips. So pushback on that, from the other part of my brain automatically says, does that matter? Is it really just the passage of time that you're going on here? Because if I go back and I look at this chart, it still does not look like a Bitcoin chart. It looks like the first 3 bumps of the Bitcoin chart, but it does not look like the totality of the Bitcoin chart. So that gives me a clue that maybe I'm overexpressing how much I think time moves faster now than it did in 1630. And the fun part is I won't know because I can't go to 1630 and live that shit. So let's move on to Bitcoin Coalition pushing back against MSCI proposal targeting Bitcoin heavy companies. Micah Zimmerman, Bitcoin Magazine, says that Bitcoin for Corporations, or the BFC, in coordination with its member companies, formally challenged MSCI's proposed rule to exclude companies from the MSCI Global Investable Market Indices if digital assets represent 50% or more of the total assets. The rule would apply to companies whose primary business is classified as digital asset treasury activity. BFC argues the proposal misclassifies operating companies by prioritizing balance sheet holdings over actual business operations. Quote, MSCI long defined companies by what they do, not by what they hold. This proposal abandons that principle for a single asset class, says George McHale, managing director of BFC. Quote, a shareholder-approved treasury decision shouldn't override that reality, end quote. Well, the coalition identified 3 structural issues with that proposal. First, it redefines primary business based on asset composition rather than the revenue-generating operations. Second, it singles out digital assets while other asset classes face no similar treatment. And third, it ties index inclusion to volatile market prices, creating unpredictable membership changes. I agree with all of those. And the first one is my favorite. The proposal from MSCI to exclude companies like Strategy redefines the primary business of a company as based on its balance sheet composition rather than how they make their money. I think that right there is enough to put the kibosh on this whole thing. Will it? Oh, hell, I don't know. People are saying there's an 80% chance that MSCI will take the Strategy out come January 15th or whenever their decision date is due. I can't remember when. I think it's mid-January. But other than that, I've made the argument that businesses should be looking at their treasury as something other than just their treasury, that they should be looking at it as an asset that they can leverage, and not in a bad way. I don't mean like going 3x long on Bitfinex or something like that. I'm just saying leverage it to, I don't know, build other sectors of your business. Use it. Use it as the weight that it can have. And yet here comes MSCI saying, oh, well, it's your balance sheet that defines your business, not what you sell, not what you specialize in, not who you sell your shit to, not your customers. No, that doesn't define your business. No, it's what you have on your balance sheet. Well, that doesn't make any sense if you look at the history of business for the last 11,000 years. It's what you do, not what you save. Okay? Let's be clear about that. Anyway, the BFC warned that the proposal could lead to passive fund outflows, higher capital cost, and increased volatility for companies, all unrelated to operational performance. The group urged MSCI to withdraw the threshold, maintain an operations-based classification, ensure asset and class neutrality, and engage with market participants on a business-aligned framework. Strive Asset Management, co-founded by Vivek Ramaswamy, also formally urged MSCI last week to reconsider its proposal to exclude companies. In a letter to MSCI CEO Henry Fernandez, Strive warned that the rule could produce inconsistent results due to differing accounting standards under U.S. GAAP and IFRS rules. Strive, the 14th largest corporate Bitcoin holder with over 7,500 Bitcoin, argued that the 50% threshold is unjustified, overbroad, and frankly unworkable. Quote, end quote. Its executives highlighted that many Bitcoin treasury companies operate real businesses in sectors such as AI data centers, structured finance, and cloud infrastructure. They compared the proposed treatment of Bitcoin to other assets, noting that energy companies with large oil reserves or gold miners, they're not excluded from the indexes. The firm also cited market volatility, derivatives exposure, and accounting differences as factors that can make index inclusion unpredictable, and Strive warned that strict rules could drive innovation abroad, giving international firms a competitive advantage. It's January 15th. MSCI plans to announce its decision January 15th of next year. Strive's intervention reinforces the broader industry call for operations-based clarification or classification, asset class neutrality, and fair treatment of companies holding significant Bitcoin as part of its treasury strategy. Perhaps the company most affected by this would be Strategy, the tech and Bitcoin-focused software company famous for its bold Bitcoin reserve strategy. Strategy and Chairman Michael Saylor recently pushed back against concerns that MSCI could exclude the company from major equity indices. So there you go. That's pretty much all we really need to know about this. So Vivek Ramaswamy is pushing back. You know, that we're finally getting some people other than just, you know, the Bitcoin for Corporations, which is kind of like a little bit like a lobby group, finally getting some people that are not Michael Saylor strategy based into the mix, calling this bullshit. And those three reasons are honestly, those are all impeccable reasons. Let's see, redefining primary business based on asset composition rather than how you make your money, singling out digital assets while any other asset classes face no treatment whatsoever that looks like this, and that it's tying index inclusion to volatile market prices, which create unpredictable membership changes. And that third one's important too. I mean, all three of these are important, but the third one and the first and third are the most important, I think. I really do. Because that third one is like, look, if you can't show some kind of stability in what's contained in these indexes, then why have an index? It doesn't make any sense to have an index that constantly changes the shape of changes its shape because of volatility, and they're getting included and excluded all the time. There, you know, if we're going to do it that way, we should probably have a lot better structures on how equities or companies or assets get included into indices in the first place. So again, we're all waiting with bated breath for January the 15th to see what these idiots do. Anyway, Saylor pitches Bitcoin-backed banking system to nation states. Like I said, the Bitcoin boys over there in Bitcoin Mina at Abu Dhabi. So Cointelegraph's Nate Kostar is going to tell us more. Michael Saylor, executive chairman of the world's largest Bitcoin treasury holder strategy, is pushing nation states to develop Bitcoin-backed digital banking systems that offer high yield, low volatility accounts capable of attracting trillions of dollars in deposits. So this is part of what I mentioned yesterday, but Michael Saylor has a theme that he's brought to Bitcoin MENA, and this is part of that ongoing theme, right? So let's get into it. Speaking at the Bitcoin MENA event, Saylor said countries could use over-collateralized Bitcoin reserves and tokenized credit instruments to create regulated digital bank accounts that offer higher yields than traditional deposits. Saylor noted that bank deposits in Japan, Europe, and Switzerland offer little to no yield, while Euro money market funds pay roughly 150 basis points, and U.S. money market rates are closer to 400 basis points, that's 4%, and said this explains why investors turn to the corporate bond market, which wouldn't exist if people weren't so disgusted with their bank accounts. That was a direct quote. Saylor outlined a structure in which digital credit instruments comprise roughly 80% of a fund, paired with 20% in fiat currency and another 10% reserve buffer on top of that to reduce volatility. If such a product were offered through a regulated bank, depositors could send billions of dollars to institutions for higher returns on deposits. And the account would be backed by digital credit with 5-to-1 ratio over collateralization held by a treasury entity. And he's talking about himself right there. Come to strategy and we will provide that as the treasury entity. Anyway, according to Saylor, a country offering such accounts could attract $20 trillion or $50 trillion in capital flows. And he argued that a nation adopting this model could become the digital banking capital of the world. The remarks followed Saylor's revelation on X that the company purchased 10,624 BTC, and we talked about that all yesterday. But we continue. Saylor's description of a high yield, low volatility digital bank product echoes elements of Strategy's own offerings. The company introduced in July STRC, which is a money market style preferred stock with a variable dividend rate of around 10% and a structure designed to maintain its price near par while being backed by Strategy's Bitcoin-linked treasury operations. Although the product has already grown to around $2.9 billion in market capitalization, it has also been met with some skepticism. Bitcoin's volatility is one reason that some observers question Saylor's push for Bitcoin-backed high-yield credit instruments. Bitcoin has delivered strong long-term returns, but its short-term performance remains difficult to predict. At the time of writing, Bitcoin was trading around 90,700, about 28% below its all-time high, yada, yada, yada. In October, Josh Mann, a former Salomon Brothers, however you pronounce it, bond and derivatives trader, called Saylor's moves folly. Oh, it's all folly. Put my monocle in and call it folly, and suggested STRC could suffer a liquidity event. He wrote, quote, "The fiat banking system has been around a long time and has figured out how to build a moat around demand deposits so that they don't break the bank. Hiking rates on STRC to maintain and defend a peg or price level is not going to work. When depositors want to get their money back out," yeah, that goes for banks too, you moron. Did you see what happened a few years back when we had 4 major banks fail because they couldn't meet deposits? Actually, one of them could, and one of them did, and they still got hosed by the FDIC. These argumentations being made by these economists they're all getting old and stale very, very quickly. As the dominoes continue to fall, so will those arguments. So that was the last that I had for you today. It is Tuesday, so y'all go out there the day before Hump Day and go slaughter everything you see. Get as much as you possibly can. Do stack as many sats as necessary for you to feel comfort in this coming new year, which is getting real close, to 2026. So I do hope that I am able to come to you during the Christmas break. I can't promise anything because when we go to Christmas, I'm in a different house. I don't have my regular setup and I don't have my regular schedule and the kids aren't in school and, and all that kind of stuff. All right. So bear with me. If for whatever reason I'm not coming to you because we are going to leave here pretty quickly and I'll be gone for like 2 weeks. So if you don't hear from me, I'm not quitting the podcast. I would just consider it that Dave's gone on vacation and I will see you on the other side. This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.